The realtor made their commissions, mortgage agents will make their commissions, the builder will make their money. The only person who is losing here is the client. But they are struggling now to cover their losses of about $180,000 because of this particular tool. Their home value became $1 million and they got very excited, but they still owe the builder $734,000. In only 1 year, my home was worth $625,000, but the builder can actually sue the client. That's the worst kind of use that you can have of your HELOC. So in my view, the right way of using HELOC is that you use it to make. Today, we are going to talk about a tool which can be used to destroy lives or make a lot of wealth. So let's get started. Now, for those of you who did not guess, we are going to talk about home equity line of credits. We are going to talk about what is HELOC. So short form for home equity line of credit is HELOC, and this is very commonly used. This is very loosely used as well. So we'll just define what HELOC is. Then we'll talk about how can it destroy wealth, and we'll take examples, which is a very recent example. The client actually came to me. They became a client later, but they are struggling now to cover their losses of about $180,000 because of this particular tool. And then I'll talk about how I use HELOC, because I also have a HELOC on one of my homes, and how it can make you rich, and what is the best way to use it, and what are the safeguards that you need to have in play in order to use HELOCs. So let's first talk about what is HELOC. So by definition, a home equity line of credit or HELOC allows you to borrow money using your home equity as a collateral. What I mean by that is, if you have equity in your home, let's say your primary home is worth $800,000. Your mortgage on that is, let's say, $500,000. You have $300,000 of equity. You can borrow part of that equity, and when you borrow that equity, you don't actually have to pay any interest till the time you use that equity. So it's just available to you, and I'll give you an example in a bit, and then you can use that to build wealth, or you can use that in the wrong ways to destroy wealth as well. So let me just give you an example of how HELOC works. First of all, there are certain facts that we need to know. You need 20% plus equity in the house to get a HELOC. Because bank is actually giving you a loan against your house, you at least need to have some equity in the house, and that number is at least 20%. So if your house is worth $100, let's say in a hypothetical example, and if you have $95 of loan on it, you cannot get a HELOC. That's a very common question that I get with new home buyers. Can I get a HELOC on my house? No, you cannot, because your house is not worth as much and you don't have enough equity in it. The second one is you do not pay interest on unused HELOC. What I mean by that is, HELOC is just a line of credit which is available to you. You do not pay any interest on that till the time you have actually use the HELOC for something, and you only pay interest on, let's say you have $20 of HELOC or $20,000 of HELOC. If you use only $5,000, you only pay interest on that $5,000. And the third one is that HELOC is only on a variable. HELOC cannot be on a fixed rate. It has to be on variable, and usually it's prime or prime plus 0.5, which is the most common. For those of you who don't know what prime is the prime lending rate. Right now it's 7.7. Bank of Canada actually decides to reduce the rate. So when people say that, Bank of Canada is increasing rates or reducing rate, what they are basically doing is they are just increasing or reducing, loosely speaking, the prime rate. And with that, the interest rate on your house increases or reduces. So HELOCs are only variable, it can only be on variable. Now let's take an example of how HELOCs work and how different things work. Let's say, and this is actually an actual example. I bought my condo for $420,000 back in February of 2021. So the purchase price was $420,000. We did a minimum down payment because we were actually living in that condo. So we did a minimum down payment of 5%, which is $21,000. The loan balance was $414,000. And now you might say that, why is the loan balance $414 when I've done $21,000 of down payment? That's because of mortgage insurance. When you're doing a less than 20% down, you have to pay mortgage insurance as well. So it's $420,000 minus $21,000 of down payment plus mortgage insurance. So my loan balance becomes almost $415,000, and I have equity of roughly $5,000, which is 1.2% of the purchase price. So I only have 1.2% equity in this particular house to start with. Then what happened was everything broke, like lose. 2022, the market actually went up so significantly that in only 1 year, my home was worth $625,000. I don't think, it was warranted. It just increased because people were willing to pay. The interest rates were so low. It was all inflated. We all know the story, what happened in 2022. Now, my loan balance at that time, because I was paying, a little bit more towards my mortgage, for that 1 year, my loan balance reduced to about $402,000. And therefore, I had an equity in this house of $223,000 purely because my house value increased because the market was crazy at that time. So I had hypothetically $223,000 of equity sitting in my house, which is about 36% of the home value. So 223 minus 625, that's 36%. Now I can do two things if I have to go to the bank and take some money out. There are two things that I can do. First of all, the bank will not lend me more than 80% of the new value. So if the new value is $625,000, the bank did an appraisal on the house. It came up to about $625,000 and they cannot give me more than 80% of it. That means my new mortgage cannot exceed $500,000. So I went to the bank. The appraisal came in. I got an overall limit of $500,000 on my mortgage. Now I can do two things here. One is I can take that equity out into my bank account, and because it's debt, I don't pay any taxes, even though it looks like I'm taking in profit, but I'm just taking out equity, which is actually debt. I'm actually taking more debt on the house, right? That's equity takeout. That's what a typical refinance is. So when people say that they have refinanced their house, what they mean is they actually took out equity into their bank account. The second way of doing this is instead of taking money in your bank account, you take something called as HELOC, which is home equity line of credit. You don't take money in your bank account, but there's like a facility which is available to you when you need it. So the numbers, how they work on this is if I were to do an equity takeout, my overall rate on the entire $500,000 will be prime minus 0.9. And prime at that point was close to 4%. So my overall rate would have been about 3.1 to 3.2% on the entire $500,000. Now remember, my mortgage was only on $400,000, roughly $402,000. But if I do the equity takeout, now I have to pay interest on the entire $500,000. So I basically get $98,000 in my bank account. That's equity takeout. Now in HELOC, things are a little bit different. I do not increase my loan amount. So my loan amount on the house still remains $402,000 at prime minus 0.9. So I pay the 3.1, 3.2. Obviously, it's a lot more right now. But at that time, it was about 3.1, 3.2%. And I only pay interest and my payments do not actually increase. And I took a facility of $98,000. This is basically a line of credit on my home. And if I use it, I pay prime plus 0.5. If I don't use it, I do not pay any interest on this. That is the fundamental difference between an equity takeout and a HELOC. So of these two options on this particular condo, because these are real numbers, I actually chose to take a HELOC because I did not actually know what to do with the $98,000. I just wanted it, just in case I need it. But yeah, I just took a HELOC and it did not increase my mortgage. It just gave me a facility of $98,000, which I still have. Now that we understand what HELOC is, now let's take an example of how not to use a HELOC. I'll give you a very real example that came to our table just last week, where the client is actually now bound to lose almost $180,000 because they used HELOC. So let me just take you through the example. Just bear with me. There'll be a lot of numbers here. So basically, they have a primary home which they purchased in 2017 for $450,000, and they actually paid the house pretty aggressively. And now their mortgage on that particular house is only $270,000. This is the outstanding loan as of today. The primary home value is actually $750,000 because between 2017 and now the home values have actually increased. I think their home value is a lot more than $750,000, but conservatively speaking, it's about $750,000. The problem, this obviously makes, a lot of sense, right? They have so much equity in the house. It's all good. Their life was going really well. However, when the home values increased in 2022, their home value became 1 million and they got very excited. Their realtor got very excited. Their mortgage agent got very excited. The market was any which ways very excited, and they did something that just, led to their downfall. They didn't know that, right? They took a HELOC, which is a home equity line of credit, like I explained in the last slide, of $180,000 on this particular house. The reason why they took a HELOC of $180,000 was because they were buying a pre-construction back in February of 2022, which is the peak of the market, for $900,000 plus the development charges. And I'll talk about, the development charges as well in a bit. but they bought it for $900,000 and they had to pay 20% in 1 year, which is $180,000, which is exactly the amount of HELOC that they took. So it was all planned. They needed $180,000 in 1 year. They could not save that much, and therefore they took out money from their primary home, which is exactly what they needed, $180,000, and they paid it towards their pre-construction project. Now, condo is getting delivered in June of 2024, which is just 2 or 3 months, from now. The value of the condo is no longer $900,000 because they bought it at peak of the market. Right now, the value of the market at best, if they sell on assignment, will be $740,000. So there's a $160,000 gap. The problem with pre-construction is when you go to the bank to get a mortgage, they will not lend you on $900,000 because the value of the house is not that. Therefore, they actually are now lending the client money on $740,000, which is the new value. So they cannot give more than 80% of 740 because it's an investment property, which is $592,000, but they still owe the builder $734,000, which is basically 900 minus 180, which is 720, plus development charges, which are basically, when there's more development that happens around, there are some taxes that are put. It's already in your contract when you're buying pre-construction that development charges are capped at 12,000, 15,000, 10,000, 5,000. This was capped at 12,000, and they charge the entire $12,000 to $14,000. And now the client owes the builder $734,000 plus closing cost, and they will only get $592,000 from the bank. So what that means is this puts a difference of almost $142,000 plus closing cost, which they have to pay from their own pocket right now. That's actually not it. The problem is that they do not have any cash right now because they have a $180,000 HELOC, which is at 7.7% interest because they took the HELOC at prime plus 0.5%. They are paying almost $1,150 a month in only interest. The $180,000 loan is still there. They are only paying interest on that, which is almost $1,200. Plus, because of all this financial stress that they had, one of them actually lost their job as well. And that actually put them into further debt, and they took an unsecured line of credit at 12% of $40,000 to cover their expenses, and that's another $400 per month of payment on that. So they have almost $1,600 per month that they are paying in interest on the unsecured line of credit and the HELOC, which is just putting a lot of pressure, and that is depleting all their savings, and therefore they actually do not have the $142,000 difference that this has put them into. The options that they have, they are no good options. We just have to choose the best out of the worst. The first one is you pay the difference. That would be probably be the most straightforward one, that you pay the difference, $142,000 plus closing. They can't do that because they don't have that money. They default on the condo and lose the deposit, but that's not as straightforward. Let's say they say that, okay, we are ready to get rid of the condo, we are not going to close on it, we are not going to pay the development charges, but the builder can actually sue the client because they promised. It's a promise on agreement. It's not like it's a contract, and if you default on the contract, the builder has the right to sue you. So that's the other problem that they have, so they can't do that. The third one, and which is something that they were contemplating, they can actually sell their primary home and move into the condo. Because their primary home has a lot of equity, they can actually sell that. They can make a lot of money because it'll be a substantial amount of equity that they can take out, and they can put it into the condo. They can cover the difference and anything, and then they move into the condo. But the problem is that they're a family, they have kids, their kids go to school. They can't just uproot everything and move to the condo because condo is pretty far from where they live, and that's not the most it's not the most ideal option given their family situation. And that's where we are actually doing the fourth one, where they sell the condo on assignment. So the assignment sale will be like $740, $750 at best, and they book a $180,000 loss because they already owe the builder $734. So even if they sell the house for $740, they barely are able to pay off the builder, and they lose the entire deposit that they put on the house, and that's where it's a massive financial loss. And then as a mortgage solution, what we are doing is we are consolidating all that debt of $180,000 and the $40,000 of unsecured line of credit into their primary home, so that they only have to make one payment and they don't have to make your mortgage payment plus the debt. Everything is very messy, plus it's a very high interest debt that they have. So what we'll do is we'll just include all those payments that they have, all the debt that they have, in their primary home. Now, this is one of the examples of where everything was going really well until they decided to use their HELOC to buy an expensive condo, and that actually led to all this mess. The realtor made their commissions, mortgage agents will make their commissions, the builder will make their money. The only person who is losing here is the client. So this brings me to my next slide on how to lose money with HELOC. This is something that you should absolutely avoid. And the first one is buying pre-construction with hopes of appreciation. Because even though Canadian real estate historically has gone up, you cannot put your money on appreciation. It's like, playing roulette, where you put black and white, and 50% of the times you'll probably win, or less than 50% of times. That's what pre-construction is, right? So you're actually, it's a hope. It's not a sure shot thing. Nothing is sure shot. Everything has risks, but pre-construction, I really feel that if you use debt to buy pre-construction, it's actually taking a big gamble, and that's something that we should absolutely avoid. Buy long-term real estate, especially with negative cash flow. Let's say someone says that, oh, you should buy this because, it will appreciate in value. And even if you make $500 of negative payments every single month, it's negative cash flow, you are fine, and use your HELOC to buy this. Don't. Because it's long-term real estate, you have to make sure that you are positive cash flow, at least if you are using your HELOC. And I personally do not like to use HELOCs for long-term real estate, because I also have to, let's say in that example where $180,000 of money is used to buy $900,000, I'm making negative cash flow on the real estate, itself, the mortgage that I take for the new house. Plus, I now have to service the HELOC as well, and that loan is at a very high interest rate as well. So either I make $1,500 to $1,600 of positive cash flow on my second house, and then I can take the $1,200 of negative on my HELOC, and then overall I am positive. Even that's a very risky approach, but still, that's something that you can do. But I don't like using HELOCs for long-term real estate, because at the end of the day, you are actually taking 100% of debt to buy something, which is just not possible in Canada in most places. I would never buy stocks or GIC for that matter. I don't know why people do that. Why would you take loan of 7 to 8%, even if it's a secured loan on your house, to buy something which will give you a 10% return? Make arbitrage of 2%. Yes, it's depreciating. That's an appreciating asset. I understand all that, but I still don't think it's worth using debt on your home, primary home, to buy stocks and GIC. Just do it with the money that you have. Do it with your income that you're earning. Have a side hustle, make more income, and do that. But yeah, I would not use equity from my primary home to buy stocks or GIC. And then never take a HELOC and use it for monthly expenses and buying liabilities like cars. That's the worst kind of use that you can have of your HELOC. I would never do that, because you would never be able to recover that money. If you use it for your grocery, you cannot recover that money, because you're going to eat that grocery. If you use it for your car, the car value is going to depreciate and you can never recover that money. So never put it into monthly expenses or liabilities, and never put your primary home at risk. Because if you take loan against your primary home, it can be called. If you do not have any equity, or if the home values depreciate and you have taken, let's say I had my condo was worth $625,000 in 2022. If I had taken that $98,000 and used the entire amount, I would be negative on my loan. My home is not worth more than $450,000 to $500,000 right now. If I had taken a $500,000 loan that time, if I sell that home, I make zero profit. So I have zero equity in the house if I actually use, obviously it's my, investment property and I'm okay. But if you do that with your primary home, you are at a risk of being negative on your loan on your primary house, which is supposed to be a safe haven. So I'll never put, that under risk. How do you actually use HELOC? So I used HELOC in a very different way, and I'll explain that. And again, bear with me. I first of all used about $20,000 to build a deck on my primary home. I'll tell you why I did that and how the calculation worked. First of all, I used $20,000. So mine is, you can see from this picture that it's a walkout basement. So if I build a deck, and if I build a pretty big deck, I actually improve the house, value of the house, because there are only 4 houses in that lane which have a walkout basement. Plus, if I build a deck, then it gives more usable space to whoever is, buying my house. And looking at the comparables, I knew that if I put $20,000 in building a pretty decent deck, I can actually increase the value of the house by almost $40,000. So that's where I used $20,000. And the interest payment on that is $128 a month. But that was not it. I still have to pay off that $20,000, right? So there's a plan for that. And because this, as well as my Ohio investment was happening in tandem, I could actually just, club my HELOC use towards both. So one is I made improvement on my primary home and increased the value of the house, and I used HELOC towards that. The second one was that in January of 2023, we actually closed on this property in Ohio, which we bought as 4 partners. So there were 4 partners in this particular property. We purchased this for US dollars $449,000. So it's a pretty good purchase. It's an 8-plex unit. If you have not watched the video, go and watch the video. I've done the numbers there as well. The rent on this at the time of purchase was $5,200, which is pretty decent. It was cash flow positive, $600, $700, from the get-go. These are all numbers in USD, by the way. However, this particular house required renovations, and the plan was that we'll buy this, we'll renovate all the units, all 8 units, we'll increase the rents, we'll do some improvements in the common areas, and I've again explained that in my video that I made on the Ohio investment. And we had to put almost $100,000 Canadian, which is around $70,000 USD into this house. So because I was one of 4 partners, I put $25,000 towards renovations. And after we did all the renovations, I think we have spent about $95,000 till date of the $100,000 that we raised for this. The value of this particular entire building has increased by almost 250,000 Canadian dollar. By putting $100,000 into the renovations, we were able to 2.5x in terms of return that we got, because the rents have now increased to almost $7,500 to $7,600. So the interest payment for 1 year, because I took this, from my line of credit again, was $160, dollars a month. And overall, now I have a debt on my HELOC of $45,000 for the last 1 year, and my interest payments are almost $300 per month, including, both the improvement that I'm making. And in 1 year, I pay almost $3,500 of interest. I've already accumulated that, and I've been paying it every single month. But there has to be a plan of paying all this off, and there is, because now the units are renovated and and the rents have increased. The after renovation value of this particular 8-plex is almost $650,000. Let's say conservatively it's $625,000, and the rents have increased to almost $7,500. And again, these are all US dollar numbers. The equity that we can take out, and the refinance is happening next month. The least amount of equity that we'll be able to take out will be about $130,000 US, which translates to $32,000 US for me, because I'm 1/4 owner of this particular property, which translates to about Canadian dollar $42,000. And that I will use to pay off the $45,000. Yes, there's some shortfall, but that's how I'll pay off the line of credit in June. So in May, we refinance this. We take out $42,000 from this Canadian. We pay off the $45,000 of line of credit that I have on my condo and make it whole. And, I just made the interest payments for 1 year to make all that happen. So in my view, the right way of using HELOC is that you use it to make short-term real estate improvements that increase the value of the asset by at least 1.5x. For instance, I made $20,000 of improvement in my primary home, and I increased the value by $40,000. So, that's a 2x increase on the amount of money that I invest. Same way in, Ohio, we put in $25,000 Canadian, which is not a lot of money, and we improved the value so much. Now I own both these pieces of real estate. Because of the increased value on the Ohio property, I'm able to pay off my HELOC. So it's a short-term improvement. That's just 1 year. And I still own these pieces of real estate with, obviously the primary home is not giving me any cash flow, but my mortgage has not improved, increased on this. And the Ohio one is still giving me a lot of cash flow, a lot more than where we started. And this basically means that I've increased my net worth, and at the same time, I was able to pay off my HELOC. So it's a short-term increase, and I've increased, the value of my assets by using this HELOC for short-term. The other question that you need to ask is, because these are not risk-free. What I did with Ohio and, using my HELOC, it's not risk-free. I could have lost everything. So don't get me wrong here. I'm not saying everyone should do that. But you need to ask yourself, can you risk it all? And only risk that money, even if it's HELOC or your own money, that you can afford to lose, because there is risk. Now, real estate has, less risk if you know what you're doing, compared to other asset classes, I would say. but still it's a risk. So my risk on this entire thing was $45,000 with a $300 per month interest payment, and my primary home has $300,000 of equity. Then I have Calgary house as well, there where I have equity. So I have enough equity to take that $45,000 of risk. And worst case, if I lose it all, like all $45,000 get lost, I still own the assets, I still own the equity. I'm making $300 per month additional payments. It's not hitting my bank because it's minimal to the income that I'm making. And this is a risk that I was willing to take. So again, there is risk in what you're doing here, but at least it's calculated and it's measured. It's not like unlimited amount of risk. This is the only money. If you lose this, you'll not be able to pay the next month's grocery. If it's not that, only then take that risk. And you can potentially use this money for emergency fund for investment properties. Now, don't confuse this with emergency fund that you have, like personal emergency fund. That's separate. That should not be, your HELOC, because HELOC is at the end of the day debt. But whatever investment properties that I buy, I make sure that I have about 3 to 6 months of, monthly rent sitting in my bank account in case I do not get rent for, a couple of months. And this HELOC, because now I have a HELOC, I actually do not have that money sitting in my bank account. If, it's not happened yet, but if a tenant doesn't pay me, I'll simply use, the HELOC to just cover the difference till the time, we are able to sort that situation out. I'm not saying this is the most ideal thing to do, but for some people, I think it's a good way to use your HELOC. You don't pay any interest till the time you use it, and you have, a little bit of peace of mind, on your rental properties. That's all I have for today. I hope I was able to explain what HELOC is. I hope you got some idea of how not to use your HELOC and how to use your HELOC. I think I have had this question a million times. There are certain situations where HELOC does make sense. There are many, most of the situations it does not make sense. So make sure that you're working with a team who is advising you in your situation, and they are putting your interests over their commissions. Because obviously, if you use your HELOC to buy real estate, I make money, the real estate agent makes money, but the only person who risks money is you. So make sure that you're working with a team who is in it for long term. Make sure that you're not risking it all, and never put your primary home at risk. That's all we have for today. मिलते हैं अगली वीडियो में, तब तक के लिए बाय बाय.